Not since the Great Depression have we seen what just happened over the last 24 hours. But what is it and why should we be paying attention as traders and investors? Are we heading for a 50% correction or more? In today's video, we talk about the slump, the fastest ever recorded almost, and of course, we need to discuss the supports that may have been found. As markets across the world show correlation, dark pools start to rise. But what might be the most important chart is this one or the options market. Why is that? Well, in today's video, we'll talk about why everybody is currently bearish and how that could create a relief rally over the next couple of sessions. Join us as we cover stocks, commodities, and cryptos to talk about the good, the bad, and of course, the ugly. Well, guys, we don't see this very often. The S&P 500 just entered a technical bear market. It relief rallied during the session, and in today's video, we need to talk about the latest macro data and, of course, dark pool activity. If it's your first time here, then remember to subscribe and smash that like button. We do create daily videos about markets, and obviously, we cover everything from stocks to commodities to cryptos. But let's begin by discussing the bear market that we just entered into. Will we get a soft landing once again, or a big hard landing like a recession? Well, the problem is the stats are not really for you if you're thinking that you're going to get a soft landing. 2022, 1987, as you can see here, 1966, all periods where the markets actually had the no recession. The problem is, especially when you're looking at the 60s, which we've often correlated in these markets right now, it looks like we got a recession a few years later. Does that sound familiar with where we're at right now? Well, of course it does. Now, does that mean that you don't want to be looking at relief rallies and it isn't possible that the market could make a new all-time high? No, that is possible. With one of the fastest sell-offs that we've ever seen, it's still possible that markets could actually do this and then do that later. But we are following what we would call recessionary structure now as markets fell through some of the key levels last week. Even Tom Lee seems to be turning from being super bullish into bearish a little bit. And of course, he has written a bit of a mea culpa here of what happened in terms of Liberation Day and his thoughts on the stock market. You can read that if you're interested. Regardless of all of this, though, the stats really come back to these types of things. When you see massive sell-off on sell-off on sell-off like we did, you tend to get relief rallies. Now, often these are what we call DCBs or dead cat bounces. They can have secondary lows. And as you can see here, of the last three, which all are pretty much those normal times that we look at, 87, 2001, 2008, 1 day later, good. 2 days later, usually good. 3 days later, okay. And then, of course, things can go bad after the next 2 weeks. So do not expect volatility to decline unless we get absolutely amazing news. Maybe all the tariffs are gone or something like that. Because in general, we are in an incredible piece of volatility here. And of course, we are witnessing history together. Let's now talk about the big thing here, guys, which has got to be the only other times we've ever seen this. Futures indicate another loss of Dow Industrials greater than 3%. The futures are finicky, but that is the third consecutive loss greater than 3%. And since 1896, that's 129 years of history, this has only occurred during one time. And yes, you guessed it, it was the beginning of the Great Depression. Now that sounds incredibly scary and rightfully so, especially when you consider that was a really fast fall off. It then had a pretty nice rally and the rest was history. And this is going to have a lot of people scratching their heads. What do I do next? Should I be buying the dip? Should I be absolutely terrified? Of course, these are great questions and we'll hopefully answer those over the next coming weeks. Now, let's go through the Bank of America here, the bonds spreads. Basically, the bond spreads will be updated over the next 24 hours. We know these have become exacerbated. We are looking for these to decline. Generally, with a lot of the lows that we've found in recent times, we've seen price action increase and bond spreads tighten when we are finding real lows. We haven't seen that this time around, so of course, it means that until we get the new data, we will not know that. But there are some good signs for dip buyers out there, for people that are trying to find these bottoms in markets and saying, how much worse can it really get? Well, the good news is that a lot of major indicators are showing super oversold signals. And you might say, yeah, no, a lot have been, but these ones are very rare. The bullish percent index actually dumped all the way down into these low levels, as you can see down here. both the S&P 500 and the NASDAQ. And when this tends to happen, usually it is a bottoming of a market for that period. That doesn't mean that it is the bottom forever. It just means that basically during that period, you've kind of bottomed off and markets can find some relief. We started to see that structure as we were doing our Monday open live stream, where we saw that double bottom pattern and particularly the NASDAQ come back down to that 61.8 Fibonacci zone and find a bid. Off that, we also saw news on news on news, where basically there were releases that were literally maybe even fake, and then they had to be counteracted. And you can see how fast these algorithms go. There was a bit of release, supposedly that was a 90-day pause on tariffs, and the market shot up so quickly that you wouldn't have even been able to get in them if you wouldn't have been in them already. Then that was kind of said, well, we're not confirming that or anything. Now let's have a look. We've got a lot of oversold signals across the board. Of course, that WMA indicator showing us also oversells. And why wouldn't we? We hit a VIX of over 45. And whenever you hit VIX levels like this, a lot of VIX traders will try to short the VIX. Obviously, there are valid techniques in shorting the VIX at super highs, but not without their own risks. So make sure you're aware of that. And that's usually what most people try to do. They try to look at the VIX. Now, if you short the VIX at 20 and it goes to 50, that's of course going to be incredibly painful. So you got to remember it goes both ways. Regardless of this though, when we hit VIXs that are this high, we actually end up getting into the 60s. We tend to be at a point of at least stabilization for that period of time. 1 week later, 2 weeks later, 1 month and upwards of 2 months maybe, we sometimes form a base with sometimes a double dipping event that happens 2 months later. So again, the chance of structure being formed here is higher than normal. The same thing happens when you look at the VIX 1 month versus 3 months, very similar. 2 days later, 100% of the time when we've got stuff like this, we tend to be bullish. And you can see here that there is degradation, particularly around the 2 month window. So markets can come up, but they may not be able to hold. Now, why is this? Well, of course, it's all got to do with just basically everything becoming oversold, leverage getting knocked out of the market, margin getting taken through. So why else might we need to look at some of these markets when it comes to some indicators? RSI 14-day, here's a good read from Subu Trade. You can see here again, if we're taking a look at 2 days later, again, the stats are good. And this is just the RSI, the bullish percent index. And of course, some of the things we'll show you later on today, including PCC, they tend to be very good reads of temporary bottoms. So you might be asking yourself, how cheap is the market? Well, as you can see here from Duality Research, we've got some interesting 10-year averages being hit. In fact, the 10-year average of the S&P just got hit over the last 24 hours, 18.2 on the forward PE ratio. And that takes us from a 22 plus to an 18. That's almost a 4 overall PE reduction, which is pretty decent. Technology came down to 21.4, which is pretty much the 10-year average. And we saw financials coming back to the 5-year average after having one of the best mid-cycle runs in many, many years. That was absolutely phenomenal how much those financials went up. But of course, now they are decreasing. Now you can see here across the board, if you want to pause the video, there are quite a few opportunities should you like these particular markets. But the ones that we're going to have to look at in terms of seeing recovery in is, of course, going to be the technology and semiconductor stocks. As we know, JP Morgan raised their recession up from 40 to 60. I'm actually surprised they didn't go higher here. I thought they might have gone 70 or even 75%, considering the structural lows. But hey, I'm not JP Morgan and neither are you guys. So that's what they believe. But yes, basically the odds of a recession have increased drastically. And most of what I'm putting it on is recession and of course debt discussion moving forward. Remember, at the moment, everyone's just talking about tariffs. But what the hell is this doing to businesses out there? What is this doing to labor hiring, such as here? We already saw before these announcements that labor hiring was already going to probably be slowing because people were putting pauses on it. And this is going to mean that the Fed Reserve is going to maybe need to come out with some serious, let's say, firepower later on this year. And of course, they haven't said anything yet, but the jobs numbers will need to be watched. As you can see here, the expectation of layoffs is on the rise, and that probably has only gotten bigger. Now, the question also will be, are we heading for a Great Depression or recession? Now, Great Depression is shocking. We do not want to enter that under any circumstances if we can help it. But as you guys saw before, when you take a look at the previous kind of sell-off of the 1920s run, it was a super flash crash with a big rally, And often, if you look at the psychology of a market, this will be how these biggest ones end. Now, I do not think we should ignore the speed of this rally. What that shows us is that people have already been concerned over valuations. And remember, we have entered into quite a few very close technical bear markets for multiple years now. 2018, we got a scare there. 2020, that's 2 years apart. 2022, and now 2025. So we are continuing to see extreme volatility in the age of very high valuations. And that means that the market could compress, remember, to like 14 times earnings or even worse. And that's going to give you, that 50% off if it ever does occur. Now, let's talk about what else we're looking for us to kind of start to build that evidence. 11 days above 27.3 on the VIX would not be a good read. So far, we're quite a few days into this and we'll continue to track it together. But I think that this is probably one of the big problems. The S&P 500 broke its quarterly streak of wins. And when that's happened in the past, it may have bounced over the next quarter, which is right now. So obviously we're down, but we might bounce. But the quarter after that, the quarter after that, the quarter after that is not very good. And you can see here the stats are pretty much in the bears' favor when you're looking at the longer term. Now, let's talk about whether we have buyers at these lows. Well, it does look like at least there's something going on when it comes to big dark pool transactions. About 580 on the SPY. So the question then becomes, have we seen dark pools and Wall Street's biggest actually start to get in? Well, the good answer is yes, we've started to see them. And this is happening at two of the largest trade levels of all time back on the recorded history. This is on SPLG, which is an S&P 500 ETF. And basically somebody was placing very, very large trades into the close of the session. It wasn't just on that market either. You can see here, just to bring it back to show how many large trades have gone through on that one. And this always needs to be paid attention to because, of course, if we build structure around this point, it can be very healthy for markets. When we look at the rotation, look at this, guys. Semiconductors up 2.27, home builders down hard, down 4.13%. So this is pretty serious stuff. And when you think about it, you want to be paying attention, of course, to these things. And home builders falling to those new lows, not a good sign. That takes us to a 5-day run of home builders being maybe not the worst, but obviously semiconductors did see that huge recovery, negative 5.5 to 2. At one point, they were up even more than that just in the first hour of the session. Let's now jump onto the S&P and have a look at some updates. We've got some anchored VWAP levels in the future, such as 5,400, which is going to be a key level in the future if we do get up there. And of course, we broke into the under 5,000 line. Now, when we hit that, we basically started to deal with pretty much significant low sweeps. This is effectively a stop loss hunt, and we saw markets across the world, realistically hit so many of these. Now, there was correlation, though, that was starting to appear. And the correlation specifically was with the NASDAQ. So if you actually have a look here, the NASDAQ hit a really nice support level, obviously totally smashed 17,000, and then it kind of came down. Now, why is that important? Well, this level around here did hit and correlate with quite a few other markets. We'll just show you here HSI, which is the Chinese market. This is the most traded zone that's going through right around there. And it sold off huge during the session. We actually saw a 15% sell-off in the index in one day. That's, of course, a flash crash of epic proportions. And it went into the most traded zone. So this area in here, a very key level. Again, cross correlation seemed to start appearing. The last time we saw this was 5,400. We got no bid. This time we've seen it. We've seen some structural bid. And let me explain why I think there's some structural bid. We started to do this as we were seeing the open. So make sure to subscribe. We were doing the open show. And we're talking about this being a double bottom on the 15-minute. In fact, we polled the community and you guys were not so sure about that. You were basically about 50-50, 55-45. But in general, there's a technical double bottom. And obviously the market sold in the morning, liquidating so many people. And then it rallied off that. We got some weird news coming through, which obviously got this initial rally. And then we just started to recover on hopium. So basically the markets were recovering on hopium throughout the session. And they certainly did liquidate so many positions early. Particularly the NASDAQ would be worthwhile having a look at after watching this video. So how high can we go? Well, the general thing will be back to this level. This will be the discussion point. Can we get back to a 5,600 style market where we find a supply? Now, at the moment, we have a drop. We have a base. We have a super drop off the tariffs. We have some relief. Obviously, the market's going to be looking for some kind of good news. That good news story could be something like negotiations are going on. We already are starting to see that, or we're going to pause the tariffs, or who knows. Just remember, many bits of damage have already been done. So ultimately, this is just a relief into what is statistically more likely, which is something like this. If this does happen, even here is possible. So you've just got to remember that whatever this is for the time being, do not lose sight of the volatility that's coming through on the markets. If we were starting to argue, though, the 2 hour looks okay. And obviously the market pulling back down to around 49.85,000, that could be where the supports are. Let's have a look at the options market to kind of back that up. 5,100 of the puts. Obviously, we are below those currently, and 5,000 is the most struck level now. So this has all changed over the last 24 hours. 5,000, 5,000, 5,000 everywhere. We had a lot of 4,800s the previous session. Now we've got 5,000. So basically 5,000 is where the put support is for the S&P, and you would have to expect that there's going to be some form of support around there, hopefully appearing. Nvidia, what's going on there? Market got absolutely tanked, recovered back. Not too shocking considering $97 on Nvidia in terms of the recovery that it's had. $90 is the put level, and 100 will be a big call level. To get back into positive gamma, you're going to need to get above 100. On Tesla, it didn't suffer. Again, the same fate, 220, underneath 220, kind of where we've seen a lot of puts, and the market again held that level. So of course, 250 will be the call zone. Let's now jump into the overall lead indicators, though. The VIX got crushed from 60 back down. These are epic overall VIX levels. Of course, you do not see these very often. You can go back in history and you'll only have a couple of cases of them. But what I really want to talk to you guys about are bonds, which of course are continuing to freak off. Yes, they did find a little bit of a bid after gapping down, but they didn't. This is my bonds indicator. They didn't actually really rally. So that can actually, if this continues to go down or sideways and we see the stock market going up, it really basically makes it think that we are in a dead cat bounce. So basically a fake rally. And we do not want to be in one of those, of course, if you're hoping these things really are going up. What about the percentage of stocks above the 200-day moving average? That hit terminal levels. These levels down here are usually where you see savvy investors try to pick up the dips. And the reason they do that is because this is the oversold zone. Sometimes markets can fall another 5, 6, 7%, but the statistics are more in the favor of the bull when you get down to these levels. We haven't seen this here in a long time. October 22 was the last time we saw this. And yeah, it is a super area to show oversold markets. Home builders obviously got destroyed back down. Not a great looking chart. Certainly not liking that one. Still looks very bearish on the markets. And treasuries, as you can see here, we see a lot of consolidation in this zone. A lot of you are probably scratching your head saying, why are treasuries not up? Why are treasuries not flying like they should be? Well, a lot of it has to do with yields. Look at the yields here, actually spiking up off the tariffs and the announcements in recent days. So of course, for you to be more profitable in treasuries, you generally need the yields to also come down, and that has not been happening. US dollar is sitting at around the same areas. Again, you've got a very strong US dollar should you break the high of 104.30. And at the moment, the US dollar is still in a downward trend, although it has spiked back up. Gold started to struggle a little bit, as you can see here, sitting around 3,000, actually closing below this major support of 3,012. Now, because of that, it opens up the possibility of gold going back down into the 2,800s. And I don't think that's unusual. It did have a massive run. It obviously hit our 3,000 target. I'd still like to see $3,600 on gold, but it may not happen just yet. So just be careful there. It is technically sold below that zone. And copper, obviously, having an absolute freak out, moving back down to these previous watch reaction zones and most traded levels. So this is, of course, a huge sell-off on copper across the board. When you take a look at HSI, you guys can see what happened. It was brutal. That was a huge sell on the Chinese market. This is the most traded zone. So it's pretty much right where if Chinese stocks are going to find buyers, they'll find it. And again, I just want to reiterate, it's a correlation style thing. Have a look here at silver. And when we go to the weekly here, okay, we went below the trend line. But as you guys can see, we correlated with the previous supports and demands, and we found a little bit of buying pressure. This happens across so many stocks at the same time, so many markets around the world at the same time. They're all interlinked. That's usually a better sign that you're finding a big base. And we just didn't have much of this other than the possibility of 5,400, which of course was instantly melted by the tariffs and the reciprocal ones. Tesla 220 has remained that kind of buy pressure. We've spoken about this a mazillion times on the channel. And 250, of course, will now be the call wall for now. And then 280, 300. I expect those to be the options walls. We'll keep updating. What about NVIDIA? Well, have a look here. I'm just going to use this line, but you can see here that it kind of went underneath that low from August last year, came into this structure, found a little bit of a buy. If we have a look at semiconductors, it was pretty much that the market kind of came right down into this previous demand zone. It was getting really nasty in the morning. So obviously some nasty stuff there. You've got Wyckoff distributions up here. You've obviously seen the results of those. So Jamie Dimon and many others that sold those positions, Warren Buffett, etc., probably pretty happy with themselves. Relief rallies, you're going to have to watch things like 200 now. But there is a good chance that those levels will be hit at some point as markets like to do this type of thing. German 40, the DAX, again, correlation is the key. Big demand, you'll see. Super oversold, obviously finding a rally. This is a huge candle. Let's just put this in perspective. That is a 10% one-dayer in terms of the size. It ends up as a doji, so it doesn't know what it wants to do. But what does the doji tell us? Equilibrium. Equilibrium means structural level for now. NASDAQ, same thing. Really good price action on the daily trade. If you're interested in that, you can check it out. We also have a day trading masterclass. You would have been able to use that fairly effectively yesterday on that particular one. And of course, if we have a look at the Russell 2000, you can see here that we went down to the most traded zone, undercut it, got into the structure, basically entered back into 2022 prices and found some rallies. So we have seen a stabilization where we're waiting more news, and ultimately this market is going to be waiting for all of these good bits of news and good bits of information. So what news do you have to look out for this week? Well, of course, there is the PPI on Friday, the Thursday CPI at 8:30 a.m., and maybe more importantly than any of this is the Wednesday FOMC meeting minutes. 2 p.m. New York time, you'll have to be having a look at what the Fed has to say. But in general, this is going to be a news-led dynamic. Make sure, of course, guys, to be paying as much attention as possible to daily updates, getting the latest information, and looking for structure. For now, we've seen dark pools near the lows, although they have not always been finding bids. We've got a temporary kind of double base bottom, and we did have a liquidation event early in the session. Those things can tempt bottom the markets, but we have a lot of things to deal with in the future, including the S&P 500 hitting, of course, possibility of 54 to 5,600 in the future. Make sure to follow us over on the socials to get the latest updates. Thank you so much for watching, and bye for now. See ya.